you start the recording to make sure we're recording if you haven't yet?
Yep, I just started it.
And if you could drop the link in the chat for everyone, a link to the soft commit and the QR code, that'd be great, Nathan.
Okay.
All right, so anyway, welcome everyone. Thanks for taking time out of your busy day. I know everyone's busy, it's before the holidays, things are crazy, so thanks for joining. We're gonna be really mindful of your time tonight, but get you some info that you're craving and tell you a little bit about this awesome opportunity we're super stoked about, answer questions. My name is David Namazi. I'm a local San Diego-based physician and a real estate investor, and I'm joined tonight by several of my partners here at Coastal Capital Onyx Group, including Nicole Pelley, part of our group, who you'll meet shortly, and she's going to tell you a little bit about us and how excited we are to bring this opportunity for ourselves and for our investors. Coastal Capital Onyx is really proud to partner with the sponsor who's here tonight, Dave Gardner, the builder and owner of Highland Construction, along with the other partners, Isaac Dixon and Alan Lewis, who you will meet, who are also the brains behind this. And Dave is just the handsome man and the building guy. And as a team, they're just amazing guys. They're going to tell you a little bit about the project here shortly. I want to give a shout out to Nathan Maxwell, one of our strategic partners here at Coastal Capital Onyx Group. He is behind the scenes letting people into the webinar. So thank you for that, Nathan, and doing the recording and helping out. And just a reminder, everyone, we are recording this meeting, and that'll be for people who are unable to join in person or live tonight. And we'll be sending out a recording of this Q&A, as well as the original webinar that we did last week, which garnered a tremendous amount of excitement for the opportunity. So we'll be sending those out, as well as a soft commit form. This form will allow you to get a reservation on a spot for yourself in this opportunity, because we've had a lot of interest and it is filling up quickly. So that link will come to you by email, by text from your strategic partner contact, and will also be in the chat of this presentation. So if you feel at any point you're ready to go ahead and click that soft commit, we really encourage you to reserve your spot. So tonight, as I said, we'll be talking about the preferred equity limited partner opportunity for this investment for the Onyx on Park project in beautiful San Diego, California. And if you're here tonight, it's really because someone on our team cared enough to invite you to this private investment opportunity for accredited investors only, and to give you this great opportunity alongside of them in the super hot market of San Diego. And so welcome, and I'm glad our partners have invited you here tonight. A lot of you have reviewed the deck of slides and know a little bit about this. Some of you were on the webinar last week and know about the project, but had more questions. So we welcome everyone here, even if you haven't been here before on the webinar last week or seen the deck. We're going to go through some of that, so don't worry, you'll get what you need in terms of information tonight. And the goal really of tonight is not just go through all of it again, but to really answer any questions if you have, to get you comfortable with making a decision to invest alongside of us, which is something that we're all doing. We're all investing in this opportunity because we really love it. And like I said, if it's right for you, please just click that soft commit button and get yourself a spot, because I think it's important as those fill up. Tonight, we'll just have a brief presentation. Nicole's going to go first, just to tell you a little bit about us, who we are as a group at Coastal Capital Onyx. We're professionals that came together and really are passionate about real estate and sharing this information with our friends and family. We're going to have we'll meet the sponsors. We'll have a little Q&A. We can talk about any questions. This is the part where I have to take off my doctor hat, which I'm still wearing my scrubs from the day, so I'm still a hardworking doc. But here's my lawyer hat. I have to say that as a standard disclaimer, and if you put up the disclaimer slide, Nathan, I need to remind everyone that investment in private securities entails potential risks, including loss of capital, and that past performances does not guarantee future success. That disclaimer aside, I want you to know that our team has done a tremendous amount of due diligence on this deal, including careful evaluation of the site, the builder, the sponsor, the terms, the risk involved. And we truly believe that this investment will be a valuable way to diversify your investment portfolio with a great risk-adjusted return. And my friends often think I'm crazy lately with all this real estate stuff, and I rarely post on Facebook. And when I do put recently about real estate on Facebook, they all message me and say, "Hey, have you been hacked?" So they ask me, "Why are you getting involved in real estate? You're a doctor, you're busy. Just go do what you do." And like, why multifamily, which I really like. And as a physician, as other people who are busy, I started looking at my financial well-being as a table with legs, and I realized a few years ago that I needed to add more legs to this table, and that's why I'm here to do this for myself, for us as a group, and to all of our friends and family that we've invited to be involved in this. And so, especially in times with inflation we've had recently, when my dollars were sitting there just being eroded by inflation and being worth less and less every day. And as we've seen a little pullback in the market, some tumult going on, I think it's important to add different legs to the table. And I think that's why we're all here. So super excited. I'm going to send it over to Nicole to tell you a little bit about Coastal Capital Onyx Group, and then we'll hear more about the deal and then Q&A. Go, Nicole.
Thank you. Right. I think David already really touched on several points that's really important. Each one of you is here because of like a personal private invitation, because a member of our team felt like they believe that you need to be part of this deal, that it has something to offer you. And so although you know us as an individual, you don't know us as a group. And I think that who we are as a group is very powerful. And so I wanted to make sure that everybody that came tonight has a better sense of who Coastal Capital Onyx is. I'm going to start with our mission. Our mission is to empower high-income professionals to build wealth through strategic real estate investments, enabling them to create lives of financial independence and personal fulfillment. Folks, that's it. That's why we're here. That's why we're bringing deals like this to you. It's why we exist, because we want you to have a chance of the financial independence and the personal fulfillment. It's what drives us. We are a diverse group of trusted physicians and medical professionals. Together, we have 70 years of real estate experience. We have over $85 million of assets, either personally owned or under management. This encompasses 3,000 doors, over 3,000 doors, over 15 different states, including California, where several of us actually live. We've performed due diligence on the sponsor and on the asset. For those that were here from the very beginning of the call, two of our team members were actually on site today checking out the construction progress. We believe in this project. We believe in the risk-adjusted profile of this investment. We see this as an opportunity to diversify your retirement portfolio. It's associated with a prime placement in the capital stack. It minimizes your risk, it minimizes exposure, and with the goal of helping you gain financial independence and that personal fulfillment that we're wishing for you. So on the screen here, you're gonna see some of our team members, David, who's been speaking, Shirag, Nathan, who is behind the scenes and actually labeled tonight as Jack, Hussein, myself, and then next slide, Nathan, please. Great, thank you. We have Matthew and Cynthia, and they were actually on site today. Michael and Kawhi, Frank and Quay, and then Jack. And we as a group, this is what drives us to come home from a long day at work and do a webinar with you guys, because we want you to have this opportunity. If it's right for you, we want this opportunity to be available. I didn't know about opportunities like this until I joined this group. And so it's with pleasure that I turn it over to a little bit of a presentation, I think, from Alan.
Hi, everyone. And thanks, Nicole. I really appreciate that. And we certainly, as a team on our side, have really enjoyed getting to meet the Coastal Capital team. We work with a lot of investors over the years, and having a group of people who are smart, driven, intelligent, and get real estate and want to learn more about it, or just have this omnivorous curiosity about how real estate works has been really gratifying. And before I jump in, it probably makes sense. Let me introduce Dave Gardner and let Dave start with telling a little bit about himself. Dave doesn't like to brag, but I'll tell you, and Isaac will tell you the same. Isaac and I have both been in the industry for a very long time, both on the institutional side and just on the development side. And it's very rare that you meet someone like Dave Gardner, someone who has decades and decades of experience, someone who has literally affected the skyline in San Diego, such a beautiful city. And you'll go by and like, oh yeah, Dave worked on that building. Dave worked on that building. My last building I rented, we were up on the 24th floor, and David built it. It's one of the highest, tallest buildings in San Diego, and David worked on that, I don't know, 30 years ago. So with that, Dave, if you want to jump in and tell us a little bit about your background and what you've been up to over your career.
Sure. If you live long enough, you get to build more buildings. That's the basic bottom line there. But Highland's focused on multifamily for about the last 15 years. We've built just about every kind of multifamily project that you can imagine. We specialize in like an urban infill projects like this project here, Onyx on Park. It's a perfect example of taking a very small piece of property and getting 71 units in it comfortably. We're parked comfortably. It's a great location. You can walk to all the restaurants that you would ever want to walk to or go out to dinner very quickly. We're just about through with, basically through all the hard parts of building the building. Now we're just doing finished work, exterior and interior finish. And we're looking to be finished late March, early March, or middle March, late March, early April, depending on rain. But so far we haven't had any, so it's not much of a problem. All the permanent power is in place. We're not waiting on SDG&E. All the underground's going in now in the street. And like I said, the rest of it is just doing finish work. So it's just a really great project, and we hope to be doing several more like these in the very near future with some of you as part of our equity people. We need equity partners, and that's why we offered this pretty unique opportunity for you guys.
Awesome. Thanks, Dave.
Isaac, you want to add anything to that?
Well, Dave, you're a hard act to follow, so I think I'll let that kind of sit on its own. I do agree with Alan, though. Dave likes to, be pretty modest about what he's done, but truly, if you look at the San Diego skyline, he's been involved in one major reform in a large portion of that. And while he's been doing multifamily for 15, Highland's been in business for 31 years. And I think one of the things that I think is just important, or kind of speaks to kind of Dave and his approach to business and life in general, right, is a lot of his employees have been with him since the beginning. I'm going to screw this up because it's so many years it throws me off, but I think John's been with you for 40 years at this point?
Yeah, 42.
42 years. His CFO was hired straight out of college and has worked there ever since. He's just got a very strong team that sticks around because he treats them like family, and they all really enjoy building stuff, and they've worked together for a very long time. So that's all I'd add.
They make my job easy.
Thanks, Isaac. So just a quick background on the project and just kind of the different players. So Highland Construction, that's the general contractor. Dave's the CEO and owner of that. Dave Gardner is also what we call the sponsor of the project. When you have a lender doing a construction loan, writing a big check, they want to have one person who's a live, warm body on the hook, signing the guarantee, saying if anything goes wrong, you can come after me. And that's Dave in this role. And that's a critical role, especially for a ground up construction project. They want to see the experience. They want to see the balance sheet, liquidity, all these factors. So that's Dave. So for us, I'm with Diversity Fund, Chief Investment Officer, co-founded it back in 2016. Diversity Fund initially bought the land back in 2017, got teed up, went through the entitlement process, ran into a number of delays with COVID, shut us down for 2 years because no lenders were making loans. And eventually we got to the point where we had to bring in a partner to take over as sponsor because the lenders post-COVID wanted to see, someone who's done a lot of deals in San Diego, and that was Dave. So Dave, we were fortunate enough to be introduced to Dave. He loved the deal, loved the site, loved the location, and was willing to step in and become the sponsor. So now Diversity Fund is just a silent limited partner. Our affiliate entities basically comprise the common equity. And so now we can talk about the investment now that you understand the different players and pieces. So Nathan, if you want to advance a slide or two. Keep going until we get to the cap stack slide, if you could. There's some pictures of the asset. Keep going. Keep going. One more. There we go. All right. So the common equity investors, the diversity fund investors, we're the common equity. So as you're looking at the capital stack, which is what you see here, you'll see in first position you have the construction lenders. Lenders get paid first. That's why they make the lease. They have the lowest risk position in the cap stack. And so between the senior loan and the mezz loan, it comprises about $26.5 million. I don't have my reading glasses, so I'm going by memory if I'm a little bit off. And then we have the common equity, all the funds that we've already put in from the diversity fund side to get the deal to where it is today. And now we're raising an additional $2.2 million to get the deal through completion and through stabilization, which means we are going to start pre-leasing in January before it's even finished in March, and start to get some rental income in place that will cover the debt service going forward until we have an exit. So now with this $2.2 million is preferred equity. It's going to sit behind the construction lenders, behind the debt, but ahead of the existing common equity. And so it has a preferred position in terms of getting paid out. And what the documents effectively say is that the entity, the joint venture entity, Onyx on Park Mezz member, that Coastal Capital is investing into, cannot make any distributions to the common equity, can't pay any additional fees to the sponsor until we get the preferred equity paid. And that's the 12% preferred interest, which accrues on a monthly basis, and the return of capital. And so that puts you in a preferred position. And so as far as you're looking at the risk profile of this, you really want to say, okay, what's the building worth, right? What's the worst case scenario? In a worst case scenario, if we had to fire sell this thing, the fair market value based on actual comps of other assets trading in this local market puts us at about $48 million of value. Could we sell for more? Probably. We're expecting that. But $48 million is a very middle of the fairway type of number based on actual data in the market. And so you can see on the cap stack, when you take that $26.5 million, add the $2.2 million of pref equity on top of that, and you're at 28 and change, you can see you have a very large equity buffer between getting those dollars taken out in an exit and the fair market value at sale. And so that's why I think it really drives a lot of this deal, why the doctor group really likes this, because you're coming in, you have a fixed return, 12%, and you have a huge equity cushion behind you to buffer in a worst case scenario, which is what you always want to look at, right? What's the worst case scenario? As far as an exit goes, we're planning on selling the building. We're doing a merchant build, which means that you build a building, get stabilized, get a couple of months worth of strong financials behind you once it's all rented out. Did at least a 95% occupancy, which we don't expect to be any issue. Should take maybe 3 to 6 months, depending on the property management team. That's already starting pre-leasing in January. And then we'll put it on the market to sell it. And that sale price will obviously take out the construction loan, take out the preferred equity, pay the accrued interest. You'll get one lump payment at the end, right? You get your capital back plus your accrued 12% per year, accruing monthly. And then that's it. So it's a very short-term investment. We expect it to happen within a 2-year mark, where you're getting where we're having an exit and you're getting your capital and pref return back. And so for you looking at your overall portfolio, this would be treated as a shorter term investment compared to longer 5-term investments that you usually have in the real estate space. And it has a return with, risk adjusted for where it sits in the capital stack. So that's it in a nutshell. I don't have much else to go over except, turning it back to Nicole.
So, Nicole, before you jump in really quickly, I know everyone has probably listened to the webinar, but just a quick overview of the project, just so we know what we're talking about. Onyx on Park is a 71-unit development located in the Hillcrest market, kind of on the edge, which sits in between 3 major urban kind of hubs, North Park, University Heights, and also Hillcrest. It's about 90% complete. Which means we've done a lot of the heavy lifting, right? We're just putting in drywall now and doing the exterior of the building. we project being completed in late March or early April and stabilized by around August. So when all those pieces are moving around, the big point of this preferred equity capital stack and this constant mention of like risk adjusted returns, it's really tied to the fact that construction and development risk is largely tied to how long it takes you to entitle and build the project, right? That's a large portion of that risk. This investment allows you to get through all of the entitlement risk, obviously, and 90% or so of the build risk, right? So that's kind of the advantageous portion of this is capital stack position and the elimination of a lot of debt, a lot of risk associated with the time that goes in development.
Okay, great. Thank you. Very quick overview, but like I said, or like has been said, we do expect that most people have had an opportunity to already review the deck and possibly see our the webinar, the first webinar. So I'm going to sort of get to the nitty gritty. You know, one of the things that we really like about this opportunity is the fact that we're building a relationship with the sponsor, a sponsor that we believe in. And to that end, they're actually even vetting an equity deal for us for early next year. And we're really looking forward to sharing that with everyone. That will also give us an opportunity to provide amplified returns for any repeat investors. But first, we have to finish this raise. And so I'm going to sort of go through what's required. If you feel that this is a good opportunity and for you and your portfolio, you can click the soft link. I did share that in the chat. Or I'm sure you've received 1 or 2 or 3 or more emails from the strategic partner that invited you here tonight. That soft commit link should be in any of those emails. That soft commit link is just that. It's a soft commitment. It's not a legally binding commitment. It just sort of is holding your spot there. This is a smaller raise. It's only $2.2 million. At this point, we are about 70% subscribed. We do expect it to fill up. So that soft commit will sort of lock your spot in so that you can have time to review the offering documents. Once you do that soft commit, you will get a DocuSign in the next 24 to 36 hours, I would imagine, that will have that subscription document. That subscription document will be a legally binding document once you've signed. So you really want to make sure that you spend some quality time and maybe have a cup of coffee because it's long. But, you know, it has to be thorough so that you're protected, right? That's the most important thing. That's what that document does, is it protects you and your investment. Once you sign that, you will be given wire instructions, and then you will also be asked to fill out an accredited investor form. This is a really fast thing to do. It takes about 5 to 10 minutes if you have to do it online. Alternatively, you could take it to your CPA who can attest that you meet the SEC regulations, compliance regulations. I think that's probably all I need to say to wrap up. Other than please put your questions in the chat so that we can answer them. And we're so grateful to have each of you here tonight.
Yeah, that's awesome. Let's hit some of these questions, Nicole. What do you think?
Sounds great. Let me find my list.
Isaac, I think I'm going to throw this one to you, but someone's asking about the risk of investing in ground up development. And I think you talked about it a little bit, and you've taught me a little bit about this, is this risk adjusted return, right? And you talk about buying a penny stock versus stock in Apple and what your return expectation. What makes this less risky for people? And tell us a little bit about that preferred equity.
Yeah, so there's several pieces to kind of why this is in a better position than a standard ground up deal that you'd be common equity. One is just the capital stack structure that your pref equity sitting in front of all the common equity. Alan touched on it pretty well, but essentially what that means is after that senior loan or the construction loan is paid, the next people that get paid is the pref equity, right? So before common equity gets $1, pref equity gets all of their capital back and their accrued return, right? So essentially for that to happen, the building would need to sell for around $31 million, right? Let's just say somewhere in that ballgame, right? So you have all this room from projected value of 48 to 31. That is all cushion that if this fell apart and this thing sold for $31 million, which while unlikely, I guess is not impossible with some kind of crazy thing happening, what would happen is the common equity would get wiped out completely and the preferred equity would still get paid, right? So all of that cushion acts as kind of a risk buffer, right? Does that make sense? And then the second part of that, just from an execution development risk, if you eliminate the capital stack component, is just with development, when you start, there's a lot of unknowns, right? You don't know what's going to get permitted. You don't know how long it's going to take for the city to approve you. You don't know how much that bid's actually going to cost when you have your full plans. Then you don't know how long it's going to take to build, what kind of weather you're going to encounter, what kind of problems you're going to have when you're working through 10,000 trades on site going from the ground into the sky, right? So there's a bunch of problems that can pop up. This being 90% done, 90% of those problems that can come up during entitlement or development have already been dealt with, right? So are there still things that could happen in the last 10%? Hypothetically, yes, but that is a much smaller window of issues that can come up versus the beginning of the construction process. A good example is at the beginning of this project, when we started, you start digging trenches and digging holes in the ground, right, to put foundations in. It rained for 2 weeks, right? Right? Like you can't.
San Diego. Wow.
Yeah, exactly. In San Diego, it rained forever, right? And so that was, something that we had to deal with that was unforeseen. Many items like that can pop up during construction that can add, issues. Now, this is a good construction team. They're very smart. They work around, they've seen everything under the sun, but all of those unknowns can come to bite you and impact the return. In this scenario, you have to deal with that sort of stuff. So that's a second component to it. And then when I talk about, the penny stock or blue chip or what that looks like, the difference is just like if I told you, hey, I've got a new deal for you, the projected return is 16% or 17%, but you've got to take on, we don't know what we're building exactly yet. The city's still got to approve it. We've got to find a builder. We've got to get the bid that aligns with it. Then we got to spend 19 months building it, right, to get here. And what I'm going to give you for taking off all that time and risk is another 3%, on your money. You would say, no, thanks, right? You'd say, I'm good. I'm good here. This is a very unique opportunity. These are not common, right? This is more, honestly, we're just so excited to work with your group. And we, I think this is a long-term partnership. We wanted to create a mechanism for the first deal that created a really solid investment that had a short time horizon that was kind of digestible and straightforward. Looking forward, in the future to doing, larger deals that kind of offer, higher IRR and are closer to the traditional development project.
Yeah, we appreciate that. And again, this is a partnership that is evolving and growing. And this was our first step at this partnership. And we really do, Coastal Capital Onyx really appreciates you guys opening this up and making it available to us and our investors. Someone had asked about what happens at 2 years if they don't get their money back. Would their returns continue to accrue?
Yeah, the answer is yes. And we specify this in the documents to be abundantly clear that the 12% preferred return continues to accrue even if we went over the 2-year mark. Going over the 2-year mark also triggers a forced sale right, which is a mechanism by which the investor group on the pref equity side forces us to sell the assets at a price that will take out both the construction debt and the preferred equity, along with all that 12% accrued interest that will continue to accrue up until the day of sale.
Okay. Someone asked what the market cap rate is in this area, in the Hillcrest area, would you say? Isaac, that's probably your domain.
Yeah, sure. I just pulled a CoStar report recently for Q2. They're sitting just above like 4.5, right? Yeah. So right around there. If you're not from California, all these numbers seem almost too good to be true. But the reality is 4.5 is soft, right? So in the peak, these things were trading in the 3.5 range, right? So we've seen the same expansion that other markets have seen. We just started from a much lower basis. So 4.5, 4.75, that's about what you're seeing these days. And we believe that's pretty stable at this point. We think most of the shock on pricing has kind of gone through the market, and we've seen a lot of demand for this newer product. So there's still a healthy market of buyers. So we don't see too much more expansion coming.
That's excellent. Nicole, do you want to speak to, someone had asked if their CPA doesn't give accredited investor letters, and Quay may want to talk about this too. But you want to speak a little bit about TriVest and how we can get people accredited?
Sure, absolutely. Yeah, I actually had this problem myself. So either sometimes your financial planner will do it, sometimes your CPA will do it. If not, you will be provided a link for parallel markets. It's super fast. It's a online third-party verification process. It takes about 5 to 10 minutes. Like I said, this is how I had to do it myself. To be an accredited investor, you have to have earned at least $200,000 in each of the past 2 years as an individual, or jointly 300,000 with a spouse or partner. Alternatively, you can use net worth. That would be a $1 million of net worth, excluding your primary residence. Once you've signed the offering documents, then that will trigger the next steps, which will include that accredited investor status. But super simple. I had my answer from parallel markets within, I believe, 6 hours. So, and it was this time of year, right around the holidays. So super fast and super easy.
Very good. Very good. Let's see. Track record. Someone wants to know about Dave, about your track record. Now, I know you've built half of San Diego, and the buildings are still standing from what I can gather. I'm sitting here looking at quite a few of them. But tell us a little bit. People want to know, your history and that you're not going to run away.
No, after 31 years, we're not going to leave, that's for sure. Track record, we've done developments, public-private developments, for the last 30 years. But like I said earlier, we've been focused on multifamily because the need is so great in San Diego. And we just knew that we couldn't build enough apartments in our lifetime, basically. But we've specialized in projects about 150 units and down. We try not to get too big. That's institutional money, and they're a lot more complicated. So we try to stay with the infill projects. And we've done, we probably have around 3,500 units either complete or in planning right now or under construction. So that's about our relative size for apartments alone. But we've built city halls, police facilities, major police facilities, high-rise buildings, several of those. And we're a local San Diego contractor that sometimes we venture out into Riverside or Orange County, but we pretty much stay home. We stay pretty busy over our 31 years of life right here in San Diego.
And the anticipated completion date, i.e. when we're having this rooftop party, Isaac, is looking like spring 2025, right?
Correct. Yes, that's correct. I do want to touch on, I was able to read the full question on the pref equity component. I want to add a little bit of color because I think I can make this a little bit clearer. And it's actually really important because all pref equity is not the same, right? Like a lot of things, people can use that pretty loosely and you think you're getting the same kind of deal, but it's not the same. When you're looking at pref equity, what you really want to focus on is the spread between the last dollar in for your money and the projected value or value of the asset, right? Because I could hypothetically issue, a bunch of pref equity, but if the thing was really worth 30 million bucks, then you're not really in a great spot, right? Like you're not as protected as you want. So the name pref equity unto itself does not make a good investment. The good investment is the spread between last dollar in the pref equity, which in this case is about 28.7, right, Alan? Does that sound right? Yep. So 28.7 and the projected value of 48, that $20 million buffer is what makes this such a strong investment, right? And so you want to say like your pref equity to value, I guess, right, is what you really want, right? And the bigger that spread, the stronger the investment is, right? So when you're looking at pref equity deals, that's one of the most important components to kind of focus on because sometimes people will use the word pref equity, but when you look at it, you're actually levered to the hilt anyway, right? And so it doesn't really help you. So that's a really big factor if you're comparing other deals. There may be other great deals out there too, not to say that they're all bad, right? But that's a key thing you want to make sure you've got your eye on.
Awesome. For those that live in California, maybe even for those that do, we really need housing badly. And one of the things that these folks are taking advantage of to help this housing crisis, and just mind you, 7 of the units are affordable housing units, by the way, and we'll be helping folks Like we met a couple of little old ladies that live in a old building across the street that approached Isaac the other day when I was visiting to ask him about if they could move into this building when it's done. And so some of those units will be affordable. But we're taking advantage of some rules, relaxed rules by the state of California, and specifically in San Diego, to allow us to make a deal like this profitable by building this number of units in town. So I think that's an important part of this, that and as well as the affordable piece.
And David, I don't think those two ladies were really trying to rent. I think they were trying to flirt with Isaac.
That doesn't surprise me.
Just to touch on what David said, to give you an idea of what went into the density here, right? So we got a couple of bonuses tied to a lot of the laws that are in place to kind of help create housing in San Diego, because as everyone's touched on, there's just a very, very large shortage that we cannot meet, right? We can't build fast enough to meet the demand, but frankly, the base density got a 50% bump by adding the affordable units, right? So that affordable units allows you to build 50% more units than you would by law, correct? And then from there, the state has created an ADU law to create further density, which allows you to take existing space and add 25% more density to existing space. So in this specific instance, what we're doing is we're taking large 2 bedrooms and we realign them to allow to be efficiently separated into 2 really strong ADU studios, right? So that's how we got from our 50% base density, we got a bonus to 58, and then we took the ADU incentive to add another 13 units to get to 71, right? And so all of those unit bumps are what allow a site to become profitable, because at its base density, you just couldn't make this work, right? And so the city had to find problems to solve for that for developers to kind of increase housing, and this is kind of how they've attacked it. And these laws have only gotten more and more generous over time. They've gotten more and more aggressive, right? Creating a lot of avenues to find value in urban infill markets where housing is such an issue. I did see a question too, and sorry, I'm kind of taking this over here, but about parking. It is certainly a key thing and important about our project, so I wanted to touch on that. So in San Diego, again, it's a very San Diego, California issue, but one of the challenges with how much density they've allowed in San Diego, right, is parking has become non-existent in a lot of developments. So it's always a major hurdle to make things pencil is parking, right? These small lots, some you can't even go subterranean if you wanted to, and if you could, it's really, really expensive, right? So they're cost prohibitive, and if you have to park every unit, a lot of these deals just don't work. You can't get it done, so they just become scrapped. So the city was like, how do we solve for this? So they basically created things called like transit areas, which is close to mass transportation, and they started to limit or eliminate the parking requirements. They've now gotten down to no parking requirements in a lot of areas. But what you're seeing now is you're seeing large, 20, 30, 40, 50, 60 unit deals going up, vertical, very little parking, 6 spots, right, for 70 units. Those are all coming to market. There are certainly renters for those, but it becomes a little challenging, right? We'll see how that turns out from a cap rate perspective on sales. They're being warmly received, but the more of these you build, the more challenging parking will get, obviously, in the urban environment. But our building, based on the topography, allowed us to park it on 2 levels effectively, right? So what it allowed us to do is create 48 spots for our 71 units, which is about 0.6-ish ratio, somewhere in there, which is very, very strong for all the new construction coming to market, which puts us in a really, really good spot. And where you really start to have those challenges are for your higher end units, right? You want to make sure that when you've got your high-end units that you're charging $5,000 and $6,000 and $7,000 and $10,000 for, that those people have a place to park the car, because they almost all have cars, right? And so we're going to have more than enough spots to satisfy all of what I would call our super high earner units, right? And so we think that's going to be a real competitive advantage in the market.
Thank you.
Sorry, go ahead, Nicole.
Oh, I was just going to say thank you for a thorough answer on that. We do have a question about, well, why are we doing a raise for pref equity, and why are we not, when it's this close to being complete, why aren't you guys wanting more common equity?
I think we would love common equity, right? Because that's better for us. in terms of, in terms of trying to get capital raised in a relatively short period of time, we made a decision to package it and make it as attractive and as much of a no-brainer as possible. And so that's why we came up with this structure. We'd also talked, we have institutional partners that do pref equity as well, that we had been talking with, and they were teed up ready to dive in, and they've done deals with us before. And ultimately, what's driving this is it's an introduction to a new investor group. As Dave Gardner mentioned earlier, having strong equity partners who are interested in funding not one deal, but multiple deals over the course of years is what really helps you to co-create, a mini real estate empire. And that's our goal here is just we're bullish on San Diego. It's a fantastic market. It did really well in previous downturns when other markets, took huge swings in the negative. And there's just such a deficit of housing supply in this jewel of a city that just is in a beautiful location, doesn't have the smog or traffic of LA. We just wanted to structure this so it's a no-brainer for your group. And by making it pref equity, it does just that by basically insulating you from the first dollar loss risk, which hits the common equity. You now get a leapfrog that and step in just behind the construction debt. In a worst case scenario, you have plenty of equity buffer as Isaac went over. So we look at it as just trying to package it, trying to make it as easy as possible to fund it, and so we can get on to just finishing this asset and getting off the market. And I guess it actually allows me to answer another question that came in, and I'll just read it because it dovetails really nicely with this. This person said, "This sounds like excellent returns for my investment. Is there any reason returns can be delayed beyond 2 years?" And this is really if we did sell it within the 2-year mark, right? Or we have other options too for an exit, is also refinancing, where a new lender comes in, does permanent debt sufficient to take out the existing construction loan plus the pref equity piece as well. Or we can always bring in an equity recap as well. But our real big goal and what we're 95% likely to do is to sell it. That's our plan. And that's because our goals as investors, as the common equity investors, align with yours. Like, we want to get our money out. We want to get a return on our money. We can't do that until we sell and get the construction debt plus the preferred equity taken out. And so that's an aligned goal there, which is what you always want to see in a private equity deal. For us in order to get our equity out, we have to get you guys paid. And so we expect that you will have an exit before the 2-year mark. But if it goes beyond the 2-year mark, then of course you continue to accrue your 12% interest, and you have that forced sale right that forces us to sell the building. But we don't think there's a scenario where that's going to be the case. We want to get this thing sold and have a big number that makes everyone happy.
Nicole, do you think that answered this other question? Who decides to sell, and can you hold the asset for longer term than selling it? I.e., is there some wiggle room, Alan and Isaac, if we think that in 6 months we'd like to keep our 12% coming and then wait 6 months for you to sell it because you're going to get a more bang for your buck? Is that a possibility? Like, what does that look like? Who decides that we're going to sell?
Ultimately, the selling decision lies with Dave. He's the sponsor. Diversity Fund, as a common equity investor, has some input there. We're really just trying to, looking at what the market's doing. We'll see where the market's at as we get to stabilization. As Isaac said, by August of 2025, this coming year, we expect to have the building, leased up and to at least 95% occupancy, most likely closer to 100. And at that point, we'll see where the market's at. We would have to wait for, usually you get a couple months of strong financials, once it's leased up, to show to a prospective buyer before going out to market. And then the market, takes a process where you got to go interview brokers, pick a broker. They make a pretty package to list it. They go create a process where they're saying, hey, get your bids in, do your due diligence, get your bids in, within 45 days or 30 days, however quickly the market's moving at that point. And then once you have a buyer picked, they usually have 90 days to close, and sometimes they have a month extension for them to get their debt in place in order to take it down. So all that said, I think we won't be exiting before 12 months, that's for sure. And so it'll be somewhere, in that 12-month to 24-month mark that we'll have an expected sale.
Alan, it may behoove us to cover the for sale component, right? So I think if they're worried about this this deal kind of being stuck in it forever and us choosing not to sell, I think it's worth mentioning that the pref equity piece has the ability to trigger, the steps to start to sell, regardless of our opinion after a year or two if they're not paid out.
Right.
Yeah, there's some very tight timelines in there where, after the 2-year mark, if we haven't taken the pref equity investors out, then your group will trigger the forced sale right. And of course, 12% continues to accrue in that period. And I think we have to get a broker within 30 days or something, and then they have to get it listed within X number of days. And then once listed, we have to have a buyer within so many days. I don't have the timeline in front of me, so I don't want to misquote it, but it's a pretty, fairly tight timeline just to force the sale for a price that will at least take out the construction lenders plus the pref equity, including capital and preferred return that's accrued.
And that was a piece that Coastal Capital, was adamant about, which is a really good put on there, and it just kind of speaks to their DD, right? Is this is a 2-year investment? They wanted a mechanism to ensure that they had the ability to get out of this investment, in a timely fashion should things, take longer than we anticipate. We obviously don't anticipate that, and we think that there's plenty of ways to get it out, so we had no trouble doing that. But it certainly speaks to kind of their due diligence, right, and ensuring that there was a mechanism there for, I would call it worst case scenarios, right, to make sure they get the capital out in a timely manner.
And we really appreciate you guys being willing to add the details on that. And I think another important thing to mention sort of along that line, and something we also had added, is that there's no capital calls allowed for our investors. So you will not be asked to fund additional money throughout this 2-year hold. And that's just critical, I think. And thank you for letting us add that as well. To that end, also, there is another question about capital gains and taxes. None of us here are CPAs, but so with that caveat, can you speak a little bit to what the payout looks like in terms of capital gains and tax?
Sure, yeah. So we always give the caveat that we're not tax advisors, and obviously you'll have to speak with your own CPA or tax advisor, but we expect that almost everyone will treat this as equity, not debt, which means that as long as we hold it for more than 12 months, then you get long-term capital gains treatment on your 12% return. And so that's the expectation, and most CPAs will have no issue with that.
Great.
Alan, we're just going to K1, correct? Just want to make sure that we're...
Yep. Yeah, let's do K1.
We also had another question. Why should somebody invest in this versus an index fund?
So I'll touch on it, and Alan, feel free to jump in. I know I feel like I'm kind of stealing the microphone here, but I think we've talked to death now about the risk-adjusted return component, but I think alternative investments as a whole are used as a diversification tool, right? Non-correlated returns are, in my opinion, really important in an overall financial plan and financial picture, right? If you look at where a lot of the smart money, a lot of the endowments go these days, right? They've moved a large portion of their assets outside of stocks and bonds into alternatives, right? And so I would never tell someone to move all of their money out of the stock market and into alternatives. That would be not very responsible from my perspective. However, I think that most portfolios should have a component of it dedicated to alternatives because of the benefits that non-correlated assets have when the market starts to move a lot, right? I mean, we're seeing, if you're in the market like me, the Fed hit the microphone yesterday, and I looked at my stock portfolio and I wanted to go cry for a minute. So it's nice to get some of your money off that roller coaster every now and then. But again, certainly shouldn't be your only piece of investments, but it should be a portion, at least in my opinion. But ultimately, that's kind of up to you on how much you think belongs in alternatives versus stocks and bonds.
Thank you very much.
Mm-hmm.
Are our financial advisors going to like the fact that we want to move funds a little bit out of the market and into a private equity deal like this? Because
I always pose the question: if your financial advisor is getting paid, to have your dollars under their management umbrella, what do you think they're going to say? We usually find that financial advisors will find all kinds of reasons to keep all dollars possible, within their purview, which is limited usually to the stock market. But to Isaac's point, Yale Endowment Fund is one of the most successful institutional investors over the decades. They've been doing it for a very long time. And it's really cool because they actually publish their portfolio allocations each year and continue to do so. And so you can track all the way back to the 80s, which is, at this point, 45 years ago, where you can see that at that point, they invested like a lot of Americans do today, right? Where most of their portfolio, 80% of their portfolio was in stocks and bonds and the S&P 500. And over the years, they've migrated down. If you look at I think it was 2 years ago, it was the most recent one I saw, they've migrated that position down to 20% of their portfolio. So 80% of their portfolio today is in alts, which is real estate, private equity, venture capital, precious metals, stuff like that. So there's the institutional folks are migrating that way, and a savvy investor should be doing the same in order to diversify into different asset allocations.
Yeah. Do you want to speak a little bit about, someone had asked about crime, homelessness in San Diego compared to, say, San Francisco or LA, and particularly this area, because we know this area pretty well.
Yeah, I think it's hard to compare other cities because I don't live on a regular basis, right? But San Diego certainly does not equal LA or San Francisco from a homeless perspective or camps. There are a couple dodgy areas in East Village, kind of, I would call it east of 12th Street downtown, that have been a bit of a challenge. And we have seen an uptick, I guess. But again, I think it'd be the same conversation about cap rates. We're working from a lower starting point than you would say, LA or San Francisco. So, I mean, as far as our urban goes, I would call it pretty clean and manageable. There's some certain pockets that are challenging, but overall, it's pretty stable. And then from our perspective on our site, I mean, I've been there a lot, and I don't know if I've ever. I'm gonna kick myself because next time I go, I'll see one. But there's certainly no homeless camps or any issues there on our site that I've seen. Dave, I mean, you're there almost every day. I don't think there's any issues there for our site.
Yeah, no, not in this area. Downtown, and 16th, 17th Street, Island, that's pretty bad down there, but it's about isolated to downtown in a few areas, not by the library. Other than that, there's a sprinkle, but we don't ever see anybody up in this area at all. You have to walk up quite a hill to get to Hillcrest.
Yeah, I do think the hill component also is part of it, to be honest with you. Yeah. I think that it's not as close to services, right? Downtown proper is closer to all the federal buildings that they use for services that we're a little farther from.
Right.
Yeah, and by the way, Dave's office is just 3 blocks north of the site. So,
yeah, 3 blocks. Yeah.
Yeah.
Dave, someone asked what your mission is, since we've got Dave speaking right now, and I know it's going to be something about grandchildren, but I'm dying to hear what do you see as your mission, Dave?
Well, because the need is so great for housing in San Diego, and we are developers and builders, it's a lot of fun to fill that bucket, and we do it both in projects that are state-funded affordable homes, which we do all over the county, and market rate like this project, Onyx. And we tell people that we're really building for our children and our grandchildren, because people from Oklahoma aren't moving to San Diego because the cost of living is too much. And so that's the big thing, is try to keep the people that are in San Diego here and give them a good place to live. We're a pretty big supporter of organizations that help tenants in affordable housing. We've been supporting Community Housing Works for about 5 or 6 years, pretty well. They do a lot of services for their tenants so that they get help, and the kind of help that they need. And but a lot of the affordable housing is for people that work for a living, but they don't have professional, high-paying jobs, but they're working every day, and they need a place to live too.
Good answer. Someone brought up earthquakes.
Dave, just
Right.
because I like to brag about you because it's fun. Didn't you win an award recently from the BCA?
Yeah, the Black Contractors Association of America, and the first Black union in the United States was put together in a meeting that we had about a month ago, and I got to be involved with that. And they gave me an award for outreach over the last 30 something years, and it was fun. It was a lot of fun with the people that are there.
Wow. It's awesome.
I just think that just speaks to kind of Dave's, reach in the community and kind of commitment to, doing right by his community, along with kind of running a business, right? He's been a part into kind of opening the real estate world and the business to people that maybe wouldn't have known that there's opportunity there, right? And he's been passionate about that for a very long time. So I was happy to see him rewarded for all that effort he's done for the last 30 years.
And one of the things that we did in that meeting too, I have to say this. We had some journeyman carpenters become journeymen. 4 years before, we hired them off the street, about 12 guys, right out of the hood, and put them to work. And they were turning into, instead of apprentices, turning into journeymen. And that was a big milestone in their life. So that was part of the celebration. And I think of the 12 original guys and gals, I think 9 are still working for the same companies that they work on several of our jobs every year. So there's, a dozen new families that are making good money because they make 6 figures. They're not underpaid in San Diego. So that was a nice milestone for us.
So cool. Someone asked about earthquakes. Is this this is probably someone not from San Diego. Is this a concern for earthquakes, and what's the risk?
Well, in the old days, there was a big risk about earthquakes and buildings over a few stories tall. Even some of the old hollow core masonry buildings, we went back through all of San Diego and re-modified them. We gave the owners like 10 years to figure out how to do that. And but all the buildings have been designed over the last 10 to 15 years, are really well designed to take on quite a bit of shaking. I would say probably just minor damage for anything in the 7 range. You'd have to get pretty big for liquefaction to happen in more than isolated places along the coast. So we're inland here a few miles up on top of a granite hill. So we'll certainly get a bump and feel it, but probably not to the destruction of the building.
Awesome.
But you never want to, bet against Mother Nature.
We have, we want to be super respectful of everybody's time. It's been about an hour. Just 2 more quick questions. Yeah. And then the expected ROI, somebody joined late, if we could just touch that super quickly. And if you have any issues with non-paying tenants for rents in this the zip code.
So I'll jump in on the tenants, and I'll let Alan do the ROI. Does that work?
Sounds good.
So on the tenants, I think it's a really good question, and Diversity Fund and I have invested in lots of multifamily over the years and dealt with delinquency and the challenges that can cause at a property. What we've seen and what we see in our investments in California is when you're a Class A asset, when your primary renter is a white collar tenant that's a high earner, generally has a high credit score, kind of tenant, those are not where you see your delinquency, right? Because all of the tools that you have to put pressure on someone to vacate and pay rent mean something to them, right? Their credit score is meaningful. They cannot have an eviction on their record because they want to buy a house someday, right? So we see very, very, very low delinquency in these Class A assets, where we really see that regardless of kind of proper state you're in or tenant laws. Where we really see issues are in those BC assets where you're trying to transition a tenant demo, right? And you've got tenants that are less concerned about their credit score, less concerned about eviction because maybe they already have two on there, right? And so when you threaten something like that, they kind of are doing a different set of math, right? On like the eviction, while not great, is better than not paying rent for 6 months, right? So that's a much harder battle than on these Class A assets with with tenants that have high credit scores and are high earners. Usually they pay on time, and if they don't and they can't pay, they leave quickly to keep their credit score where it is intact.
Thank you.
Yeah, I'll just reiterate, our assets in South Carolina and San Antonio, they're low income, 10% delinquency across the board. And our Monterey, California assets, 60 units in a beautiful location, in a coastal area as well, 0% delinquency. So, big difference. As far as their ROI goes, 12%. This preferred returns. You're protected with a very sizable equity cushion behind you. And so you're in a risk of loss position just behind the construction debt, ahead of, the common equity doesn't get paid $1 until the pref equity is paid in full. That's capital plus 12% accrued per year for however long it takes to get you folks taken care of.
All right, Nicole, take us home. What do we do?
What do
I'm
we do?
excited. Let's get it going. Let's get soft commits.
Yeah, just a reminder that there is a link in the chat. Also, in one of the many emails I'm sure you have received from your strategic partner, there should be a soft commit in there as well. All the strategic partners will be reaching out to the folks that they invited tonight and sending that recording in the recording for tonight in the next 24 to 48 hours to make sure that you have that in case you want to rewatch it. And yeah, we're excited to have you join the team, and let us know if there's anything that we didn't address tonight that you need answers to. That soft commit will sort of hold that spot for you in line. Like I said, we're about 70% subscribed at this point. We want to make sure everybody has an opportunity to get in, and we really appreciate you joining us tonight. I think that's it.
Thanks, everyone.
Thank you.
Thank you.